In this episode, we will focus on why maize prices are increasing in Zambia while cattle prices are coming under pressure. Jacques will then mostly focus on the Zambian soybean market and why prices can stay relatively low for the remainder of this year. All in this episode, so make sure to stay tuned. I am Dr. Johnny van der Merwe and welcome to the African Agri Overview. Make sure to follow us on YouTube, where we will share regular insights into the agricultural markets of Africa. For more detailed information and reports on sub-Saharan African soft commodity markets, please make sure to contact Jacques. In the latest economic news, the kwacha lost some ground against the US dollar over the past 2 weeks, trading on 17.84 kwachas per US dollar. The US Federal Reserve is widely expected to raise interest rates by 25 basis points at its May meeting as inflation remains above its long-term target of 2%, supporting the US dollar as a result and the kwacha that weakened slightly. The latest Brent crude oil price decreased significantly the past month to $73 per barrel, which is still due to concerns about global demand and the looming economic recession. The latest EIA report showed that gasoline inventories in the US unexpectedly jumped last week by 1.7 million barrels, indicating lower demand from the US, which is putting additional pressure on the oil price. Looking at beef prices in Zambia, we saw high prices since the PBPP outbreak last year. The effect of this disease is phasing out, and as a result, the prices are starting to decrease back to normal levels. Choice grade live prices traded on 36.5 kwachas per kilogram. Standard grade prices traded lower on 24 kwachas per kilogram, which is about 45 kwachas on the hoof, while commercial grade carcass prices traded lower on 32 kwachas per kilogram. Poultry prices again came under pressure due to high stock levels and lower demand due to the stronger exchange rate. The day-old broiler price decreased to 10.33 kwachas per head, while day-old layers traded sideways on 12.67 kwachas per head. Based on seasonal trends, we are expecting prices to increase over the next few months, especially since the kwacha weakened as well. Layer cull prices decreased to 45.3 kwachas per head, while live broilers traded higher on 80 kwachas per head. The average egg price decreased to 45.3 kwachas per tray due to lower demand and higher production levels. We are expecting prices to increase slightly over the next month. Mutton and goat prices traded slightly higher on 60 kwachas the past week, with the latest lamb price between 110 and 115 kwachas per head. Looking at the latest pork prices, the bacon price stayed on 48 kwachas per kilogram. We also saw feed prices starting to increase due to the higher maize prices as well, which could put pressure on the producer's profitability over the short term. In the grain markets, the latest maize price traded higher on $280 per metric ton, soybeans decreased to $350 per metric ton, the wheat price decreased to $530, while soy meal prices decreased to $370 per metric ton. But with that said, Jacques will tell us more on the movements within this grain markets and focusing on the soybean markets of Zambia.
Good day. In this week's podcast, we will look at the Zambian soybean market. A record soybean crop was produced last year, and indications this year's crop could even be bigger. These two big crops in consecutive years have changed the dynamics in the Zambian market, i.e., Zambia becoming a big exporter of soy meal. Zambia will remain a net importer of edible oil, which mainly consists of palm and soybean oil. The Zambian government allows limited exports of soybeans and rather encouraged the market to export soy meal, the value-added product, which is sensible. Before we continue, it's important to note that all numbers used in our tables and graphs are our best estimates, given information at our disposal, and should be seen as such. This graph indicates our Zambia soybean balance sheet estimates during the last 4 years and our forecast for this year. What stands out is the large 2022-23 and 2023-24 crops. Another outlier is the 2022-23 ending stocks number. Zambian crushers usually adapt to the size of the crop, crushing more with big crops and less with smaller crops. However, during 2022-23, the government bought 100,000 tons for strategic reserves through the Food Reserve Agency. Not entirely sure why, as it is not a staple. Government is asking an unrealistically high price for the stock, and it remains unsold, and the main reason for the high 2022-23 ending stocks. The government indicated they will buy a minimum of 50,000 tons this season, and that is the reason our 2023-24 ending stock estimate remains relatively high. To put the big production numbers of the last two seasons in perspective, the next graph indicates our Zambian soybean production estimates for the past 11 years. The blue bars show Zambian crush capacity, current capacity around 800,000 tons, and it is expected a further 300,000 tons will be added over the next 12 months, as indicated in the 2024-25 forecast. Therefore, the Zambian crushing industry has sufficient capacity to handle significant further production growth. The question is how this growth in production will impact prices in the soy complex. To answer this, one needs to understand what the Zambian crusher income stream looks like. The figure on the left indicates the content of the average Zambian soybean: 18% oil, 76% soy meal, and 6% shrinkage. The figure on the right shows the crusher income stream given current market prices: 55% from soy meal and 45% from soy oil. The soy meal price is low at this point. Normally, soy meal contributes 60% or more. As indicated above, the entire soy oil supply is sold in country, and oil prices determined by import parity, as Zambia is a net importer of edible oil. The big swing factor for crusher income is soy meal. Zambia is a net exporter of soy meal. In a normal year, the excess soy meal is exported to countries like Zimbabwe, Tanzania, Kenya, and Rwanda, who insist on non-GM, which fetches a premium. However, when Zambia has a large exportable surplus, they need to turn to South Africa, where they compete with GM, i.e. no premium. This puts pressure on soy meal prices and forces crushers to offer less for soybeans, unless oil prices increase to make up for lower soy meal prices, not expected in the short-medium term. The next graph shows our annual local soy meal consumption versus export estimates, and illustrates the significant expected growth in exports for 2022-23 and 2023-24. Exports to South Africa have commenced, and we expect it will continue during 2023-24. This should put pressure on both soy meal and soybean prices. The next graph shows price history of Zambian soy meal, soybeans, and crude soy oil. Soy oil price needs to be read off the right axis. During mid-2017, soybean and soy meal prices crashed due to a large crop and slow soy meal demand. See the blue circle to the left on the graph. Between March and October 2020, prices crashed again as COVID saw international edible oil prices significantly lower and demand for soy meal materially down. Second blue circle from the left. Prices hit record high levels from June 2021 to February 2022 on the back of soybean exports to India as a result of a shortage in that country. Red circle on the graph. At that point, India insisted on non-GM, and East Africa was their only option. Also, during the same period, the onset of the Russia-Ukraine conflict saw edible oil prices spike higher. The last blue circle represents the current period where Zambian soybean and soy meal prices crashed once again, this time as a result of excessive carryover stocks into 2023-24, a record expected crop likely to force Zambia to export the majority of their surplus soy meal to South Africa, and relatively low soy oil prices. in conclusion, unless a significant need for non-GM soybeans and/or soya meal develops somewhere in the world, or international soya meal and edible oil prices increase significantly, we expect Zambian soybean and soya meal prices could remain relatively low for at least Q2 and 3 of 2023. A rough guess, prices could potentially range between $370 and $430 a ton, short, medium term, between the grey lines to be read of the left-hand axis. Thank you.
Thank you very much, Jacques. Very insightful. For more detailed information on the sub-Saharan African soft commodity markets, please make sure to contact Jacques Pienaar on the details displayed on screen. I'm Dr. Johnny van der Merwe, and thank you for watching, and don't forget to subscribe.